So this is chapter 10, and of course we just finished chapter 9, which dealt with what we call capital budgeting. And we looked at 4 different methods of ways to determine if a project is feasible. And I said at that time that I would give you the cash flows. And eventually we would get to how do you calculate the cash flows? Because what you want to do is you want to say, okay, what's the cost to me today? And what are the future cash flows that I'm going to receive from whatever investment? And then kind of compare the two. Do the benefits outweigh the cost? Well, you have to bring the benefits back into today, because time value money, we want to compare the cost today and the benefits today. So chapter 9, we looked at different methods to do that. Chapter 10 is going to talk about how do we determine the cash flows in each of those years. And this, to me, is very much accounting kind of material. So I'm going to go through it very, very quickly. You've had some of this probably in accounting. But anyway, here we go. So we call this capital investment decisions. Capital investment meaning how we're going to deploy or utilize our assets, our capital in certain projects. So there's kind of 2 big key concepts here. You can read those. And we're really looking for what we call the relevant cash flows. So the cash flows that are impacted because of the decision to purchase the whatever, the equipment, the land, the building, the business, whatever it might be. Okay? And we call those incremental cash flows. Incremental cash flows. So you just need to make sure that you understand, okay, there are sometimes we have what we call sunk costs, we'll talk about in a minute, that we've already spent the money and it may not impact, what the future cash flows are going to be. So you can ask yourself this question, and it should be included, it should not be included, because sometimes the cash flows, you may think they should be, but they aren't necessarily. So we'll go through some examples. So I just mentioned this term sunk costs. So it's costs that have accrued typically in the past, meaning that we've already paid it, it's already done, and you can't do anything about it. Opportunity cost, we've talked about this earlier, cost of lost options. So if I spend my money on this project, I'm giving up an opportunity to put it into another project. What could I be getting from that? So we have changes in, so this is an important term here, net working capital, referred to as NWC. I'm just abbreviating it as NWC. We talked about net working capital in chapter 3. The formula is simply current assets minus current liabilities. So remember, current asset would be like cash, marketable securities, inventory, accounts receivable, assets that typically get converted to cash within a year. Current liabilities, remember, something that you owe. So this word current typically refers to a 1-year period of time. So how much money we owe within a year. The financing costs don't include interest, as it's already factored into the discount rate. So what does this word discount rate mean? So if you remember, in time value money, we have compounding, which is when we take money forward or into the future and it grows, it compounds, it gets bigger. When we go backwards to the present value, numbers get smaller, they get discounted, okay? So they go down in value. Why? Because we're present valuing them. So the discount rate is the interest rate that we're using to bring back, in this case, cash flows. So we call that the discount rate. So we could say if I want a certain rate of return, I would use a discount rate of whatever my rate of return is. So bottom line is, all of these different terms end up being kind of the rate of interest that we're going to use to bring things back. We could call them rate of return, present value rate, discount rate, compounded growth rate, cost of capital. So a lot of different things. Okay. So capital budgeting relies heavily on pro forma accounting statements. So one of the main interpretations or meanings of this term pro forma is is forecasted. So this is like, sorry, is forecasted. So of course, we're looking into the future, so we're forecasting what's going to happen over the next however many years. Okay? So here's how we compute cash flows. And once again, there are a lot of different kind of cash flow categories. So right now we're talking about operating cash flows, OCF. So remember, just another abbreviation, just trying to keep things. I know it can be kind of confusing, especially if you're not in finance. You're like, what is OCF, whatever. So you just got to kind of look back here, operating cash flows. EBIT, in case you don't remember, that's earnings before interest and taxes. So how much money we have before we pay any interest, before we pay any taxes. And there's a number of ways to get operating cash flow in your book. I think there's like 4 different methods. So I'm just going to go over, I think, 1 or 2. So we take the earnings before interest and taxes. We add back in depreciation. Why? Because depreciation is a non-cash expense, so that really is a major factor when it comes into cash flows, and we'll be spending a lot of time talking about that now. And then we subtract taxes. Okay. So total project cash flows, CF cash flows, we're going to take this number up here, operating cash flows, and then we're going to subtract capital spending. So capital spending is kind of like another way of saying the investment. What's it going to cost to start this project? Okay. So we're going to say, here's our cash flows. We're going to subtract what it's going to cost to get into it, and then we're going to add or subtract any changes in net working capital. So we'll go through an example of all of this. Okay, so first I want to ask you kind of, let's just step back from this for a moment and think about business in general. So you're all either business majors, business minors. So answer this question, why are businesses started, and how do you determine if they will succeed? So if some of you may want to start your own business, what would probably prompt you to start that business? And if you did start it, or thinking about starting it, how do you know if it succeeds? How will you determine that? So this is how I think about it. Typically, a business is started to solve a problem. Not always, and it could be, hey, I just want to do a business just for fun because that's what I like doing. But anyway, a lot of times there's a need or a want out there that's not being fulfilled. Okay? And so how do you determine if it will succeed? Well, do the benefits outweigh the cost? Now, that's a really pretty simplistic explanation, but I think that's in essence what business is. Try to solve a problem. The way you're going to determine if it's going to be successful is, are you making more money than you're spending, pretty much. Right? So that sounds very simplistic. So here's an example of a guy swimming, I know it's kind of corny, in front of a big shark. Now, what business does this guy wish he would have visited before he went swimming? Shark repellent. Okay? So let's think about starting. Let's say maybe that was you. Maybe this is you right here. And you're thinking, you know what? I'd really like, it'd be great. I know when people go hiking in the Rockies, they take bear repellent. And so it would be great if I had shark repellent. So let me think of how I can put this in a can and I can sell it, and so scuba divers could have it like right on their belt. Okay? So let's say we started a shark repellent business. By the way, this is a real product. Actually, it was. I don't think it's being sold right at the moment. It was a couple years ago, and they've taken the kind of technology and used it for something else. Okay? So when I was making the slide, my wife was right there, and she says, "Oh, you should put your picture in there for when you were swimming with the sharks." So yeah, I was swimming with the sharks. Now, those are pretty big sharks. It looks pretty impressive, but it's not. Okay, so yeah, I was really there, but those are Caribbean reef sharks, and so they're really not that harmful. At least, I guess sometimes they have hurt people, but not really. So it looks a lot scarier than it is. What you all need to be afraid of are these kind of sharks, and those are called loan sharks. Okay? You want to stay away from loan sharks. So what do I mean by loan sharks? That's like these types of businesses where you know you can get an advance on your payroll check or whatever, and go into a pawn shop, and they'll give you money for whatever it is you're trying to sell, and then they'll use that for collateral. And if you don't bring the money back, then you're going to get charged an extremely high interest rate, and they're also going to keep your collateral. But anyway, okay, so enough of that. So we're going to start a shark repellent business. And there's kind of all the information that you need for starting it up. It's all right there on your outline. Okay, so all this is on your outline. One thing I do want to mention here, remember NWC is net working capital. And the way that these problems typically work is that at the beginning, we need net working capital. So net working capital, remember, is current assets minus current liabilities. So let's just say current assets is inventory, okay? So for example, let's say that we needed $30,000 in inventory, but the suppliers of that inventory said, you know what, you can just owe us for like 10,000 of it, because maybe we had 3 different suppliers at $10,000 each. So out of this inventory that I bought for 30,000, I only had to come up with how much cash. How much cash did I need when one of the suppliers said, you know what, just owe us on the 10,000. So that means current assets minus current liabilities equals $20,000. The net working capital, okay? So that would be the amount of money that I'd have to come up with. And that's what we would have typically, like in this example, at the very beginning. We'd say, okay, we have this big investment in this building or whatever, and then net working capital of $20,000. And then at the end, we're going to assume that we're going to sell all of our inventory, and then we're going to pay back our current liabilities, and so we just have a negative $20,000 at the very end. Okay, so this is at the beginning, and this is at the end. All right, moving on. So on your page at the bottom left there is the same sheet I have here, and this is going to be the same for the next 3 years. Okay, same for 3 years, and I don't think I put that on your sheet there, so write that down, same for 3 years. And this is our pro forma statement, and we're just going to assume that you know, we're going to do this business for 3 years, and here's what's going to happen. Okay? And then we're going to move on to something else, just to keep it really simple. Okay? So I want you to kind of look at all of these numbers, compare them to all of this given here to make sure you know where they come from. Okay? I think it's pretty straightforward. Now, what I want you to do is on the right-hand side, where all the yellow boxes are, and they're a little bit grayed out for you if you print it in black and white. Okay? So for example, right here, I want you to start filling in these numbers. Maybe do it on a separate sheet of paper so in case you get them wrong, or you put them in pencil or something. But taking that data that you have to the left and above you and fill in those numbers. So put me on pause and do that. Okay, so there are all of the numbers. So how do we get them? So this 51,780, this is, remember, operating cash flow. So you can go up on your page there and you can look at the formula there. And basically we're taking kind of our net income and adding back in depreciation. That's another way to do it other than what I just showed you there, but you can do it, like I said, about 4 different ways. So that's going to be the same for each year. Change in net working capital that was given. So that's an outflow. and then we're going to get money back at the end, so that's an inflow. So I know sometimes it's hard to figure out kind of the signs, but just think the change in net working capital. This means that, you know, your current assets went out. You had to spend 20,000 more than what you brought in from your current liabilities. Okay, so that's an outflow. Your capital spending. This is your original investment. It says you needed 90,000 in equipment, so you have to spend that. So that's an outflow there. Okay, so the total project cash flows would be that we're spending 110,000, and notice the zero up here. That means that's like today. And then this is after 1 year from now. After 1 year, we would have brought in cash flows at 51,780. All right? Okay. So those are our total projected cash flows. Now, I want you, without me kind of telling you, should we do this project? Should we do the project? Well, what are you going to have to know there? You're going to have to know kind of what is the what we call the cost of capital. Okay. So we're gonna use the information that we used in chapter 9. Okay, remember we had a cost, and then we had all the cash flows. So just go back to chapter 9, and there was a number of different ways that we calculated it. How would you do it? Which of the 4 models would you use? Okay, so here's the information. So you can turn your page over, and I'm basically showing you all the cash flow steps on your calculator. So you're going to use the cash flow button, and that says, hey, we're going to enter in all these cash flows, the initial cost today, and then the future cash flows, and they aren't going to all be the same. So this is minus, very important, minus 110, cash flow 0. Cash flow 1 is 51,780, and we can put the frequency at 2 because we have 2 of the same cash flows. It just saves you a little bit of work on your calculator. Then the next cash flow is the 71, right? Then we hit the NPV button, and the I, which was not given originally, I'm giving it to you now. I don't believe I gave it to you originally, okay? So what you have to know is what is, I called this last time like the hurdle rate. I called it the required rate of return. And now I'm calling it something different. I'm calling it the cost of capital. Cost of capital. And if you are a finance major, you really, really need to know what this is. So put a big star by it. I want you to Google it, and I'm going to briefly talk about it here in a minute. But it's a really pretty simple term, but it can get really complicated in terms of how you calculate it. So let's just look. I want to evaluate this word here, and I'm going to come back to it. I don't know if it's on the next screen or not. Yeah, it's on the next screen. But I just want to talk about it here for a moment. Cost of capital. So what's capital? So capital is like money, okay? So when we say cost, what is the cost of money? What does that mean? Well, that means if I go to the bank and I borrow $100 and the bank says the interest rate is 3%, that cost of that money is 3%. If I sell a bond as a company and I say the coupon rate is 8%, that means the cost of that money, that capital, is 8%. If I sell stock to stockholders and stockholders say, hey, we want a 10% return on our investment, that means my cost of that money, I better be making 10%, or they're going to sell the stock, and that's not good. Okay? So anyway, bottom line is cost of capital. That is also what I mentioned at the very beginning, also called the discount rate. Don't you just love this? All these different terms, but fortunately they're all going to the same number. Is what is the I that you're going to be putting in, the interest rate, if you will, on your calculator. Okay? So a lot of different terms kind of for that same interest rate. Okay, so answer that question. And here we go. You should have gotten an NPV of a little over $10,000. So should we accept? Well, if the NPV is greater than 0, we should accept. Is the IRR a good number? This is saying the internal rate of return, how much this project is generating, is at almost 26%. And what's our hurdle rate? 20%. So we are making more than our cost. This is our cost, and this is our return. So this is like our kind of like our benefit, if you will. Okay, we are making 25.8%. Money's costing, or what our hurdle rate is 20%. So we should be adding value to our business. Okay, and that's how we would make a decision. So once again, here's kind of a definition. You can pause it. I'm not going to read the whole thing, but it just goes to give you a little bit different way maybe of explaining what the cost of capital is. Now, I'm going to give you another example here of cost of capital. I kind of mentioned this a minute ago, but here's kind of just a real simple way of how you would calculate it. Let's assume that we got a $1,000 loan, we sold a $1,000 bond, and we sold $1,000 worth of stock. So we raised $3,000, all equal amounts. Okay? What would be this company's cost of capital? So when we looked at, if this company was trying to say, okay, I need to make sure that if I invest my money in whatever project, I need to cover my cost of this money. So I brought in $3,000. What amount of money? This is going to be an interest rate, okay, percentage. What percent do I need to make? Okay, so if I invested $3,000, what rate of return would I need to make? I've got a 6, an 8, and a 10. There's going to be a calculation that you should be able to do in your head because these are all the same weights. These are all 1,000. Okay, so all you would do is you would say 6, 8, 10. What is the average? Okay, well, you hopefully can do the average in your head since they're all nice and evenly spaced out. The average would be 8%. Okay? Or you can add the 3 up, divide by 3, and you get 8%. Okay? Now, that's easy because these are all 1,000. So they're all equally weighted, so you can just take a pure average. What happens if you have, say, 2,000 here and 8,000 here? What would you do? How would you calculate this? I'll give you a clue. You would take what's known as the blank average. The blank average. Got the answer? Okay. I'll tell you that the word starts with W. W. Okay. And the answer is the weighted average. Okay. So if we have $10,000 that we have raised, that means 2 out of 10, or 20% of our money, is at 8%. 80% of our money is at 10%. Okay. So we would have to do the weighted average. So I want you to calculate that. You can just simply, all you're going to do is you're going to take 20% times 8%, and that's going to be 1.6%. 80% times 10%, that's going to be 8%. We add them up, and we would get 9.6%. That's what we call a weighted average. So in finance majors, you're eventually going to get to another class, and they're going to talk about the WACC, the weighted average cost of capital. Weighted average cost of capital. And that is a critical number for corporations to know, because whenever they're thinking about investing money, they've got to know how much do they at least need to make to decide if their project is feasible or not. And that's kind of what you would have to do on a personal basis if you're saying, you know what, I've done this before. When I was younger, I would take money from the bank. I would borrow money because I used to be a stockbroker, so I was really into it. But I would take money, borrow it from the bank, and I would buy stock. And the bank would say, charge me 6%. That was my cost. So I would say, okay, I'm thinking about buying whatever, Apple stock. I got to make sure that I'm making more than 6% in a year to make it worth my while. Now, sometimes I did, sometimes I didn't. But anyway, and there's no guarantee you're going to be able to make that. But anyway, that's what firms are trying to do. Okay, so just to give you an idea, um, this is still pretty relevant. Maybe the rates are a little bit high because banks are looking probably not quite for well, for a commercial loan. So we have here, this is like expected returns versus different types of debt versus equity. So we have debt here and equity here. So banks would lend money to businesses, and banks are going to say, hey, we need to make about 6.5%. Private equity means that the company is not public yet, you can't buy into it, but private individuals might give money, and it's very similar, not a whole lot different than venture capitalists. So venture capitalists are going to invest in businesses that are very speculative, high risk, and they're looking to make about 45% return on their investment. Banks are going to pick companies that are not that risky, and they're only looking at making 6.5%. Airbnb, over the years, so we can see all the way back to 2009 when they kind of started, they were looking for investors and private investors and venture capitalists, and they would sell stock, but not to the public. And each year, the price would kind of go up. Look, if you got in right here, 2 cents a share. And the price would kind of keep going up because, during these years, people didn't know if Airbnb was going to make it. So it was very risky. There's a lot of businesses that start out like Airbnb and go bust. And here's like the valuation of the firm. And I'm going to go online and see what the valuation is today. Because what happened, this is a number of years ago, 2017. And then they went public in 2021. They had no wait. Yeah, I need to look up the date. Not too long ago. Let me see here. So it was actually at the very end of 2020, and they went public. It was actually a little bit lower than this price per share, but then today's value is around like $200. So anyway, that's Airbnb, just as an example of a venture capitalist. All right. Draw a person kind of holding a shield. There we go, holding a shield. Now we have an attacker here. Kind of hold it. This is with I don't know, a knife or something. Okay, so I know that's kind of corny. But this is like the IRS guy right here. This is the IRS guy, and these are our profits over here. So this is Mr. Profits, Mr. Profit, and the IRS guy, or Mrs. Profits, whatever. Sorry, anyway. What's protecting the profits is this shield. This shield called depreciation. Okay. Now, yeah, I know that's really corny, but the whole point is depreciation protects your profits somewhat. Okay, so think of it this way: if I had $100 profit and I had depreciation of $100, how much taxes am I going to have to pay? None, because I'm going to subtract this. I'm going to say I got 0 left. Okay, so I don't have to pay any taxes. So here's some of the details here. Okay, so remember, depreciation, non-cash expense. So here's our depreciation tax shield. We just take the depreciation times the tax rate. It's as simple as that. So I have that already on your page there. But if you look off to the right, I have 2 examples there. Okay, firm A and firm B. So firm A and B both have sales of $300, but B has this depreciation of $100. So what is the profit? So 300 minus 0 is EBIT, earnings before interest and taxes, of 300. Okay, so we're just drawing a line there. Taxes at 10%, So 10% of 300 is 30. Subtract that. We have profit of $270. We do the same thing over here. And we have $180. So which would you prefer, A or B? Well, A is giving you a lot more profit. However, remember that this 100, you didn't write a check to anybody. So that money is still in the bank. So what would be your operating cash flow? It didn't change. It's still 270. Okay? Why? Because there's no depreciation. So 270, 270. Here though, our we add back in our depreciation and we got $280 in the bank. So I'd rather have $280. So even though your profit is lower, your cash flow is higher. And cash, this is kind of the thing to remember, cash is king. Cash is king. We want to have the cash. Profits are one thing, but really because of the depreciation, you really want to look at kind of cash flows to figure out how much money do you really have there. Okay? So what happened, notice what happened between these two numbers. We started off with the same 300, and the only difference between these two is this $100 depreciation. So what we are benefiting, we're taking 100 times our tax rate, and this means that we have what we call a $10 tax shield. Okay? Tax shield. So it means that by having this $100 here, we were able to get an extra $10 in our cash because why did that happen? Because notice what happened with our taxes. Taxes 30 compared to 20. So by having depreciation, that raised our expenses, lowered our profit, so we don't have to pay as much income tax. Income tax went down because we had more expenses. But we didn't have to pay those expenses, so that was good. Okay? So there's a number of different ways you can compute depreciation. We're going to talk about probably two of the most popular. And you've done probably straight line in accounting, probably didn't do what they call makers. So straight line, take our initial cost minus what we think we can sell it for in, say, whatever, 5 years, and then we take it by the number of years of its life, or however long we're going to have it. So if we bought something for $10,000 and we think we're going to sell it for $2,000 in 4 years, that would mean 8,000 divided by 4. Our depreciation would be $2,000 a year. Okay? That's straight line. So it's the same amount each year. The modified accelerated cost recovery system says the IRS says, here's what your computer, your equipment, your car, whatever, should last. It should last, and they usually have classes like 3, 5, 7, 10, I think years. 5 and 7 is the most common. And then they give you a percentage. So in year 1, you would take a percentage of this, okay? A certain percentage of that, and that would be your depreciation. Year 2, another percentage. Year 3, they're like different percentages each year. It's very frustrating. No way you'd ever memorize them anything like that. And by the time you're at the end of whatever your life is, that would depreciate it down to 0. Okay? Okay, so almost there. So a few more terms. After-tax salvage value. So salvage value is what you can salvage out of the asset that you have when you're done with it. And so if you can sell something for $5,000 at the end, like I mentioned here, I said salvage value was $2,000. What you can sell when you're finished. Okay? After tax salvage value, so there's implications sometimes when you can sell your asset. Okay? So we have book value of the asset. If the salvage value is different than the book value, so what is book value? So you take cost minus depreciation equals book value. Okay? So for example, if you paid $100 for something and then you depreciated it by 80, you would have a book value of 20. And if you sold it for 30, then you made a gain. Okay? You would have a gain on that. So you received 30. Okay? This would be like your salvage. You received $30. The book value is 20, so you sold it for, you had a $10 gain. Okay, $10 gain. And then you have to pay tax on the gain. You have to pay tax on that. Okay? So, to reiterate, book value, we take the initial cost minus total that we've depreciated. The after-tax salvage value, and we're going to use this when we're calculating all of those cash flows. So we did a cash flow example on the first page. Now we're going to add in this additional element of after-tax salvage. So we have salvage and after-tax salvage. So salvage is like what you can sell it for. Okay? Minus T, T is the tax rate. T times salvage minus book value. So up here I had like 30 minus 20 was the book value. And that means what that's telling the IRS is that you made a $10 profit on selling it because you've depreciated it down. You've told the government that, hey, this thing has a value of $20, a book value of 20, but yet you're selling it for $30. So you just made a profit of $10. So you have to pay tax on that. So let's just say you're in a 30% tax bracket. You have to pay $3 on it. Well, you sold it for 30, and now you got to pay tax on it. So you sold it for 30 minus your $3, and so after tax, you would get $27. So that's what you would use in your cash flow calculations, okay? So, at the bottom of your page, I want you to go through all the numbers and try to calculate them at the very bottom, and then I will go through it. So put me on pause here for a moment. Okay, so here we go. At the very bottom, salvage value is equal to 20,000. Why? Because it says we can sell the truck for 20,000. So the reason that we have after-tax salvage or salvage value at all is because we've used the maker's system, and that's when the government says, okay, here's how long you think you're going to. This is what the life of the product is. I'm sorry, the asset is, but you're going to be buying a truck, and you know that you're not going to use it very much, so you're probably going to be able to sell it more than what the government says, because the government's going to depreciate it down to 0 after 5 years. And let's just say after 5 years, you think that you could sell it for $20,000. Okay? So the salvage value is 20,000. Okay, and makers will depreciate it down to 0. So the book value is 0. But if you sold it for 20,000, so this is salvage minus the tax rate of 40%, which was in your given, times salvage value minus 0, okay, would be equal to after-tax salvage value, okay? And that 12,000 then would go in your cash flow statement kind of at the end of the project, right? So that's after-tax salvage value. So this chapter was all about figuring out how to determine the cash flows that go into your capital budget that you would then use the net present value, the IRR, and so on. So you can kind of argue that maybe it's not laid out the best way, but if you remember going back to the very beginning of the class when I said, here's what corporate finance is, here's what we're going to work on this semester, it was kind of all about how do we determine if we should go into business, and how do we raise money to go in business, and so on. So now we're figuring out kind of the nuts and bolts of figuring out all the cash flows that you would use when starting a business And then what we just got done in chapter 9 is figuring out how you would use those numbers to determine if it's a yay or nay, okay? And then we're going to go forward in the next chapter and evaluate this cash flow statement even further. That's it for chapter 10.